Hey, what's going on everyone? It's Griffin here, and even though the markets have been red over the past couple of weeks, I really hope that you're maintaining a positive investor mindset and looking to take advantage of this market correction for some longer term gains in your portfolio. Now, this is basically the second week straight that we have been seeing the markets bleeding, and yes, this past Friday prices were up slightly on the day as we can see from this heat map, but even still, we're seeing major American stock indexes taking a beating for now over 2 consecutive weeks, and most stocks in my portfolio at least are still down at least 10% apiece, and even some of them reaching above 20% that has been shaved off over the past couple of weeks. The S&P 500 hasn't been affected all too badly though, since this index holds hundreds of companies in many different industries, and the hardest hit stocks have by far been the tech industry as well as EVs and a couple others. So it is only down 2.36% as of close on Friday since its peak on February 12th, and where things are getting quite a bit more intense though is with the NASDAQ 100 that has actually just turned negative for the year as of Thursday, down 8.25% from its peak in February, which is massive for a full index, mostly attributed to capital moving away from certain industries like big tech specifically, which the NASDAQ is obviously highly concentrated in. So yeah, if we head back over to this heat map right here of the S&P 500, we can see that it's mostly in tech and EVs that we're seeing the worst performance over the past month, and then in other sectors like financials, it's a completely different story. So this isn't a market-wide crash such as what we experienced in March of 2020. Now, I have seen a couple other creators on YouTube mention that it might be a little bit too premature to say that we're in a full-on market correction or market crash, that is, but in my view, I would beg to differ here, because even though we are seeing heavy sector rotation with capital moving out of big tech and a couple other industries towards some other more cyclical and consumer defensive industries like financials, banking, as well as energy that all tend to do better in periods of higher interest rates and inflation, well, the reality though is that big tech makes up such a large relative portion of the American stock indexes now that any form of capital movement away from these firms has such a large ripple effect on the rest of the entire market and most likely a lot of our portfolios. And just to get everyone watching this up to speed with what's going on and why we're seeing such a heavy market dip on certain industries, there are a couple catalysts in particular that are at the root cause of this, so let's speak about these right now. So the first catalyst is that Congress in the United States is nearing another round of stimulus, and this has a lot of investors expecting that we'll see supercharged economic growth as well as significant inflation over 2021. And so this has quite a few investors worried also that the federal government may raise interest rates to attempt putting a stop on the economy and to keep inflation at bay, even though Jerome Powell has mentioned in an interview on Thursday that they'll be keeping interest rates near zero. Now, as a side note, this is somewhat contradicting though, since on one side they're printing money like crazy with new stimulus packages and stating that they'll keep interest rates low, but on the other hand, he's also mentioning little to no impact on inflation, which I think has a lot of viewers in the market confused as to what's really going to end up happening, and confusion in the market is typically not a good thing. And the second main contributing factor is, let's not forget that we are currently in earnings season, and this typically comes with higher levels of volatility, and this in combination with the stimulus news and inflationary fears has the market out of whack right now. Now, on Thursday, I did make a post on my Patreon page essentially explaining how the temporary market bounce back that we saw last week over a day or so was a typical bull trap, where on the way down we see temporary price recovery, and this is something that is highly typical of a market correction. This did happen last March of 2020 and multiple times in 2008. And even though the markets have continued to dip since last week, I'm not upset about the fact that I did invest a smaller chunk of my liquid capital into some high conviction stocks that I really believe will do well over the coming years, especially considering my investor horizon, right? I'm not looking at touching this capital for multiple years in the future. So for that reason, I'm able to capitalize on some of these opportunities that I see fit as of right now. But ultimately, no one really knows when the market market bottom is actually going to be. So for this reason, my overall thesis here is that investing smaller chunks of capital and dollar cost averaging into the market throughout this correction is the way to go. This has been my investing strategy for years now in terms of buying into the market. So I pretty much always invest smaller chunks of capital into the market regardless of if the markets have been up or down. Now, obviously right now I am deploying quite a bit more of my liquid cash into the market than during a bull market, but even still, this has been a strategy that's worked out quite well for me, even considering the quickest market crash in history that we experienced last March. And so with that said, my recommendations and thoughts around the current market environment really haven't changed all too much, other than the fact that I have been mentioning over the past several months that being cash heavy is definitely going to be advantageous with nearing all-time market highs and market valuations as we were seeing last month or so. And so for this reason, I am staying more cash heavy. I had roughly 20% of my actual brokerage account in cash, and as of last week, I deployed about 5% of that liquid capital into the markets. And now this week on Friday, I once again purchased quite a few more positions for around 2 or 3% of my whole portfolio in the markets on Friday. And I want to level with everyone watching this right now that, yes, it's difficult as an investor to see your portfolio shave off 15, 20, maybe even 30% in market value, but this is really part of the game as being a longer term investor, and it's paramount that you maintain a strong outlook and strategy relating to your investments and not just cripple under the emotion of seeing your investments go down in value and sell at a massive loss. Had you cashed everything out back at the bottom of the market in March last year, look at where you'd be right now. So anyways, last week I released this video right here going over 15 individual stocks as well as ETFs that I was buying into, and since releasing that video, pretty much every single position has continued dropping down in value, but that's okay because this week I purchased more chunks of each one of these funds and individual stocks, which we're going to be speaking about in today's video. So I know that was a pretty long introduction to today's video, but I didn't want to just jump into some ETF and stock picks. I wanted to give some more market context and information about why the market's continuing to dip. So anyways, if you want to get in on the daily conversations that I have about stocks, the market, and other investments with our community on Discord, make sure to check out the link down below. We'd love to have you join the community. All right, so starting with the ETFs that I was buying this week, well, on Friday, I bolstered my position in the NASDAQ 100 once again. So this index is getting totally hammered, but the thing about this index is that it holds the largest and most influential companies arguably in the world. So now having dropped by more than 9% over the past couple of weeks, this to me is a very nice opportunity to buy in once again and ride through market recovery over the coming years. I bought into the NASDAQ 100 through two different ETFs, QQQ for the American portfolio, and then HXQ is my go-to NASDAQ 100 ETF for my Canadian portfolio. Now, I bought some last week. The market has continued to shed off, and so I bought another roughly $3,000 worth across both of those ETFs on Friday. Moving on, I did also purchase some ARK-K and ARK-F shares, which are ARK Invest's actively managed funds, which we've spoken about actually quite a bit on the channel. ARK-K is down over 30% from its all-time high, reached only a couple of weeks ago, which is absolutely unreal, but they invest in companies that, regardless of financial market movements, are making substantial advancements in multiple facets of our society, all of which I believe will result in ARK-K doing well for a longer term hold, especially considering that it is down 30% right now. And regarding ARK-F, well, this is the FinTech Innovation ETF, holding companies like Square, PayPal, Tencent, etc., which are only going to gain user growth and further acceptance over the coming years, especially with the relentless rise of e-commerce. I have absolutely no doubt and strong conviction in this fund as well. This is why I bought some on Friday. Moving on, I also further bolstered my position in two of the Evolve ETFs, being the Hero ETF ETF and cyber ETF. With that said, only some small positions though, and these hold companies involved in e-gaming and cybersecurity, both of which are sectors that I believe will do tremendously well over the coming years based on data that I was able to gather. Again, definitely make sure to check out the last video that I made where we dug quite a bit deeper into these individual exchange traded funds if you want more market information about the cybersecurity and e-gaming markets. So that's it for the exchange traded funds that I purchased on Friday. To me, a market correction is just as beneficial to buy in on some individual stocks than it is to buy some exchange traded funds and further bolster my positions in some of these funds, because I actually hold quite a few exchange traded funds in my portfolios and they act as a nice solid base for diversified exposure to multiple different facets of the industry that I want exposure in. So seeing a 30% market correction, for example, on our this is definitely a buy for me. But with exchange traded funds out of the way now, let's make sure to smash the like button, and also let's now speak about individual stocks that I purchased on Friday. So the first one is PayPal, ticker symbol PYPL, and this company we dug into very recently. It's a massive American payments processing platform that allows users to easily pay for and receive payments for e-commerce sales and pretty much anything else you can think of. As of Q4 2020, PayPal had over 377 million total active users, which is an unreal amount of active accounts, and it's evident from this growth chart that the rise in e-commerce is also having a high growth impact on the number of users that a fintech company like PayPal is able to acquire. And really, I just see the entire fintech industry as a whole continuing to grow at a quicker and quicker pace, with PayPal being one of the top players in the industry. And this is as a result of e-commerce capturing a larger and larger portion of the retail sales worldwide each and every year. So there's only going to be an increase in online payments processing. And so PayPal is a company that I see being a top player, and I definitely want to hold them in my portfolio considering the current market valuation. All right, now the second company that I bought more of on Friday is Corsair Gaming, ticker symbol CRSR on the NYSE. And again, this is a company that I did more of a full overview of in one of my recent videos. But with the stock price continuing to fall this past Friday by over 2.6%, I bought more because I truly believe this company will do extremely well over the coming years. I'm definitely looking to hold on to my shares of Corsair Gaming as this company rides through the wave of e-gaming and esports, gaining a tremendous popularity. Corsair Gaming produces products like full gaming computers, gaming keyboards, audio products, memories, pretty much everything that a gamer needs to build a full-on gaming PC, and gaming has grown tremendously in popularity over the past several years, and moving forward, the growth of gaming and the sales of gaming hardware will undoubtedly continue to climb at a rapid pace. Now, at a share price that was under $30 per share throughout the course of Friday, I was happy to buy more of this stock. It's bringing down the overall valuation down slightly, and considering their current and future sales verticals, including hardware, but then also potentially some software verticals, I think that Corsair will continue to grow their spot as a top player in the gaming industry. All right, moving on to the next stock that I purchased on Friday. This is a company that I first purchased into over 2 months ago now, and it is TruLiv Cannabis, ticker symbol TRUL.CN in Canada and TCNNF in the United States. So TruLiv is the 4th largest cannabis company in the United States in terms of revenues, following Curaleaf, Green Thumb Industries, as well as Cresco Labs. But in Florida, where this company is actually based, TruLiv currently has a 53% market share of the 4-week moving average for cannabis flower. So that's a really large portion of the Florida market, where the company without a doubt dominates the state. Now, this company has also seen massive revenue growth year over year since 2018, and now over the trailing 12 months, revenues of $367 million, which represents roughly a 45% revenue growth over the 2019 calendar year. As you're most likely aware, if you're a subscriber of the channel, by the way, if you're not a subscriber, make sure to subscribe because we speak about stocks and other investments every single week on this channel. But anyways, I'm extremely bullish on the cannabis industry moving forward, especially in the United States, as we're seeing some major catalysts right now, like the Biden administration that's looking to fully decriminalize cannabis across the United States. This, among other things, is definitely one of the reasons why I see the growth of the cannabis industry positively impacting a company like TrueLive, which is extremely strong from a financial and growth standpoint. As of right now, TrueLive is actually one of the largest cannabis positions that I have in my portfolio other than Afria, and I'd be happy to continue buying into TrueLive if we continue seeing the stock price recede down a bit, but I have a feeling that this company is actually going to stay put in terms of share price. All right, moving on, we've once again got TLRY, a ticker symbol, a TDOC on the NYSE, and holy cow has this stock ever sold off recently. Since buying some more shares last week at around $235 a piece, it has sold off tremendously, down another 3.2% on Friday, which is unreal. The stock price is now sitting at right around $190 per share, down over 35% over the past month from its 52-week high, making this one of the worst hit stocks in the market right now and in my portfolio. And I think that this is as a result of positive virus vaccine announcements, right? So a lot of people and investors think that telehealth is very much a COVID play exclusively. And while there's definitely a higher need for telemedicine during a period when individuals are not able to physically go to a clinic, I personally don't think that telemedicine is going anywhere. In fact, I think it will continue to grow in popularity and user adoption over the coming years. So in regards to the shorter term pullbacks for this company, even though they are quite massive, I will admit, I think that in the larger scope of the future growth of this company, this will have been a nice opportunity to buy into this company. And as a side note, ARK Invest has been buying hundreds of millions of dollars worth of TDOC over the past 2 to 3 weeks as it's shedding off billions in market cap. And this is really a top stock that I'm buying during this correction. Okay, moving on, we have another stock that I spoke about recently. It is Zillow, which to me is very much a longer term play. There was a lot of fanfare around this stock over the past year with all-time low mortgage rates, and so obviously this has a large impact on Zillow's revenues. Since real estate transactions have been through the roof with high demand, this will have a positive impact on Zillow's top line. This phenomenon also had a positive impact on other competing companies like Opendoor or Redfin, but these are all companies that I definitely see thriving in the coming years, but still Zillow is my choice in this industry. I didn't end up buying more shares of Zillow though on Friday. However, it is still very much on my radar and I plan on holding the shares that I purchased last week for several years to come. Moving on to the second stock that I bought more of on Friday, we have Facebook, ticker FB on the NASDAQ. And Facebook's a company that I have bought into as of last week for the first time. It's a stock that has been on my radar for a while, but at current market valuations, this is a company that I think shows great opportunity to buy into for a longer term hold once again. Now, interestingly though, Facebook's a stock that hasn't been hit nearly as hard over the past couple of weeks like most other tech companies, and the reason for this is their extremely profitable business operations as ad rates on their platform continue to rise. Facebook is a monster advertising and data aggregation company that also owns subsidiaries like Instagram, WhatsApp, and Oculus Rift, all of which are making tremendous strides in their respective industries. Over the past couple of years, social media marketing has very much become one of the go-to ways for companies to get their message out to the world, and Facebook ads allow companies and their marketers to really pinpoint and segregate little facets of the market that they're looking to advertise to. Now, yes, there have been some recent issues with Apple and other advertisers, but the reality is that companies have billions of dollars to spend each year on ads, and the go-to advertising companies are Facebook and Google, with most companies catching on that the return on ad spend for social media is much larger and more trackable than with other mediums. So at current valuations, I really think that Facebook is one of those stocks that you cannot go wrong if you're looking to hold the stock for at least a couple of years out. And finally, for today's video, the last stock that I'll be buying on this dip is Tattooed Chef, ticker symbol TTCF. And this is a stock that I actually have already been holding in my portfolio for about 2-3 months back when I first opened up a position. Now, upon first purchasing into Tattooed Chef, initially it actually appreciated quite a bit over the course of time that I've been holding it, but has since sold off substantially, bringing the valuation back down below my initial cost basis. And its share price has followed the rest of the market in terms of growth stock rotation right now. TTCF is down roughly 29% from its peak in January 2021, bringing it back down to a valuation of only 1.557 billion. Now, this is a company that essentially makes plant-based frozen foods, which is an industry that's gaining tremendous traction as consumers are seeking out higher amounts of plant-based foods and alternatives. And traditionally, let's be honest, frozen meals have been extremely unhealthy and loaded with preservatives and sodium, so Tattooed Chef is looking to turn that around and make convenience also healthy. The company's financials have been great. We're seeing extremely nice top line growth at 135 million over the trailing 12 months, which is up roughly 58% year over year since their 2019 fiscal. Now, what's also interesting about Tattooed Chef is their share ownership. So get this, 61.5% of shares are held by insiders, meaning they have unreal internal conviction about the future of their company. So anyways, considering the future of the plant-based industry and the fact that Tattooed Chef is down roughly 30% from its peak only a couple of weeks back, I bought a couple hundred more shares on Friday, making this a relatively small portion of my overall portfolio. And that pretty much wraps up today's video, covering once again a handful of exchange traded funds and stocks that I'm buying further into during this stock market dip. Ultimately, no one really knows when we're going to see the market floor, but maintaining a longer term investor outlook, positive mindset, as well as bolstering your cash position and then a dollar cost averaging into your highest conviction stocks is definitely the way to go. I really hope you enjoyed today's video. If you did, please take 2 seconds to drop a like. It really helps the channel out, and also consider subscribing and hitting the bell button to be notified of new and upcoming investing content. Now, if you're also new to investing, make sure to check out the links down below to resources that I use and recommend for new and intermediate investors like certain brokerages. And I also really recommend that you check out the Discord community that we have right now. We talk daily about different stocks, investments, and I also give updates whenever I buy and sell positions. So definitely make sure to check that out if you're interested. And on that note, thanks a lot for watching. I will see you in the next video.